Hey guys, welcome back to the channel. Today's video is about something that's written in this particular book. Robert Kiyosaki, you must have heard me say about this guy a lot, about this book a lot, and this book actually says there's a chapter that says savers are losers. He's actually not calling savers as actual losers, but what he means is that if you save your money, you actually lose money to inflation. We'll talk about that. We'll talk about what to do to counter that. How do we not lose money and how do we grow our money? We'll talk about compounding. We'll talk about which stocks to invest in. We'll talk about what are the differences. So this video will talk about end to end on why you should invest your money, where to invest your money, and in what circumstances saving still makes sense. So let's get started. Let's get started, and I would start with my favorite cartoon as a kid. That was Uncle Scrooge. It was Scrooge McDuck, and this guy had a castle full of money. And I was always fascinated that it would be so cool to swim in a pool of money. I was 6 or 7, right? So obviously I was very fascinated, but now I believe that this guy was actually not doing the right thing, and we should not be him. We should be someone whose money is actually logged into assets. We should be someone whose money should be logged into investments. And yes, we should have an emergency fund, but we should not have a castle full of money, because that way we'll actually lose to inflation. I'm sure this guy did not know it, but in this video we'll understand how in real world, not in cartoons, but in real world, you actually lose money if you have a castle full of it. And I'm not the only one who says we need to stop money. We know Warren Buffett, whose net worth is over $100 billion, and he keeps saying that we should not be saving money and we should be investing money. And I talked about Robert Kiyosaki, who always says that you should not be saving money. He also says a lot of things that I don't really agree to, but this is something that I definitely agree, and we'll prove it with numbers. So the question is, why should we not save money? So this is basically me without the eyes for some reason. So I have $100 and I go to the bank and I save those $100 in the bank. The bank at best, in Canada at least, gives me 1% interest rate. That's the best interest rate. Usually the bank gives way less than 1%, but let's assume that they give me 1% on the $100 and I make $101. So the $100 increased by $1, increased to $101. Now I go to grocery this year. Now next year it's $101, but this year I take the $100 and I buy $100 of grocery. Now because the inflation is so high, it's at 8%. This is the government estimate. Grocery is actually growing at 10%. So now when I go to the store next year, I actually spend 10% more, and the same grocery that I bought for $100 now costs me $110. So what's happened is that the bank has only given me $1, but I lost $10 of buying power on that same grocery that I bought for $100. And this is what inflation is. And this is really, really crazy. Imagine if you saved $500 per month for 30 years. At a 30-year average inflation of 2.47%, your $180,000 will be worth 30% less. So whatever you buy for $180,000 today, you will be able to buy a lot less for the same $180,000, and that actually translates to at least 30% reduction. And what's happening is that you have been saving all this while into your bank account. You have been getting next to nothing from the bank, while the bank has been investing that money and growing on top of your money, and you have been losing buying power to inflation. So what do we do? The answer is that we invest our money. So the next question is, where do we invest our money? You can do it in ETFs, which are exchange traded funds. You can do it in mutual funds. I don't really like mutual funds because the fees are very high. So ETFs is a better option. We have individual stocks. You can buy a McDonald's share, you can buy a Tesla share, and that's up to you and your research. We'll talk about that a little bit here. We can invest in real estate, which actually grows a lot, and I'll be talking a lot on this channel. We can invest in crypto. That's something also that I'll be talking in the future videos. And then you can also invest into gold and bonds. That is a hedge against inflation, and we'll be talking about this as well in the upcoming videos. But I for now only do in the 4 things: ETFs, individual stocks, real estate, and crypto. Now this can be very, very confusing, which place to invest, how much to invest, but I'm going to make it very simple, and let's assume that you invest all your money, whatever you have every month, whether it's $500, $1,000, $2,000, you invest into one ETF which invests into S&P 500. This is basically the top 500 companies in the US and you invest into an ETF that invests into these 500 companies, and let's see what happens. And to understand this, let's go to an Excel. Now guys, to understand this, I'm not going to take hypothetical numbers. What I'll do is I'll actually go back to history. Back in 1992, which is 30 years from now, I'm going to look at the S&P 500 index at that time. And if you invested $500 every single month from 1992 to 2022, what would be the returns that you will get? And will you be able to beat inflation or not? Now, understand that there were a couple of downturns. In fact, 3 downturns that you have in these 30 years. It actually includes all of that, and we'll see what returns we get, whether the market is up or down if you invest $500 every single month. So let's assume that you started investing in Jan of 1992 and the share price of this S&P 500, which is, so what I've taken here is SPDR, which is Spider. This is the S&P 500 that has been there for the last 30 years. I will talk about the index that I actually invest in right now. I'm not doing it in SPDR. I'm actually doing it in VOO, and I'll talk about that later as well. But let's assume that you were investing in Spider for the last 30 years, starting January 1992, where the share price was close to $25. You invested $500, you got about 20 shares, and you might say that how can I buy fractional shares? You could not do that in 1992, but you can do it today using Wealthsimple. I'll talk about that in a later slide. And you keep investing $500 every single month, whether the share is up or down. If the share is up, you will get less shares. If the share is down, you will get more shares. But every single month, on first of every month, you keep investing $500. And because you have been investing every single month $500 without taking the money out, this actually grows to $1.1 million. You only invested $180,000, which could have been $125,000 if it was sitting in the bank account, but now it's worth $1.1 million. Now you might say that how is this money growing so much? And the reason why it grows so much is the power of compounding. If you put $100 today into the S&P 500 and it grows by 7%, you gain $7. Now in the second year, if the S&P 500 grows by another 7%, you will actually make money on the $100 that you invested initially, the additional $100 that you invest in the second year, and the $7 appreciation that you got in the first year. So that way the money is actually compounding. Now this is something that we actually read in our mathematics books in 6th, 7th, 8th when we were discussing compound interest rate, but unfortunately it was never applied to personal finance. Now we are doing that. But that's actually not all, because S&P 500 also gives a dividend. On average, it has given 1.45% dividend. And what I've done is, if you get a 1.45 dividend end of every single year, you actually reinvest whatever dividend you get back into S&P 500. And if you do that, your overall return over the next 30 years by reinvesting the dividends will be about 1.44 million. So if you invested $500 a month for 30 years like we saw in the S&P 500, the total money invested will be $180,000. Net worth in 2022 will be $1.1 million. And this is a 6.2% CAGR. CAGR is basically compounded growth. So that's more or less, how much the money has grown every single year. It's not a massive growth, but if you invest back the 1.45% dividend, wherever you get it, you will make 1.44 million. So if you invested for the last 30 years, starting 1992 to 2022, your portfolio will be worth 1.44 million. And that's 7.2% CAGR. Now you might say that 7.2% growth is not enough. And that's true, but it's still more than if you had saved the money in the bank account, which would give negligible returns. However, if you are an active investor and if you can identify companies that can actually grow much faster than S&P 500, good for you, but it requires a lot of research. So for instance, if we were to invest the same $180,000, same $500 every month into McDonald's share instead of S&P 500, that same $180,000 will be worth 2.16 million. So it will be an entire 1 million more. The CAGR will be 8.6%. And if you invest back the 2% dividend that McDonald's has given over the last 30 years, every single time you reinvest that into the McDonald's share, your net worth today will be $3 million. That's over 10% CAGR, and that's amazing. But the problem with this is that you require a lot of research. Companies can actually shut down. 30 years is a long time. McDonald's, Coca-Cola, Johnson & Johnson, all these are big companies that have stayed for a long time, but it's very difficult to understand what's going to happen in the next 30 years. So for me, personally, I would not invest a lot of my money into stocks because it requires a lot of active investing, and I'm not a very active investor. So I personally am okay with the S&P 500, which gives me decent return that not only beats inflation, but also puts me ahead on the investing game. So we talked about this chart where your $180,000, which is $500 per month, if you save in your bank account, that would be worth 30% less. But if you invest that $180,000 into S&P 500 for the next 30 years, you will see that the chart will grow to $1.44 million. These are real numbers from 1992 to today, so you can't really say that this has not happened. This is real numbers, including all the downturns. You'll see all these downturns, and I'll talk about that in a bit. So you're actually making 700% return on your money, which is much better than saving the money in the bank account. Now, obviously, if you put in more, you will actually get more. So if you put $500 a month, you'll get 1.4 million. If you put $1,000 a month for the next 30 years, you get 2.9 million. If you put $2,000 a month, you get 5.8 million, and so on and so forth. So now we understand that we need to invest our money because that's much better than saving the money in the bank account, because we do not lose money if we do that. But how much to invest is the question. And the answer to that, in my view, is it should be 20% of net household income. It should be as close as possible to that. And I personally do that using Wealthsimple Trade. I talked about that because I can buy fractional shares as well. So it helps me invest the same amount every single month. So that's one advantage that I have. Plus, it's a very trusted platform. So I would use Wealthsimple for stock and ETF investing. And a lot of people also ask that where should I invest? Whether it should be TFSA, RRSP, or personal account. I would recommend that you should start with TFSA. You should max it out, $6,000 per year. If your employer is matching, then you should max out your RRSP as well. Whatever the employer is putting, you should put that, because that's free money. And then whatever is left of that 20%, you should put into your non-registered, which is your personal trading account. All can be made within Wealthsimple, and that's pretty easy to do. Now, I've actually made a calculator where it will actually calculate what your household income is after tax and how much you should invest and what would it give you after 30 years. So what I've done here is that I've used the same projection that we have from 1992 to 2022, and I've replicated that. So I've assumed that the market will behave the same starting now as it did from 1992 to 2022. Now, I know it's not a fair assumption, but it's still a long enough time frame to take. So let's assume the market will behave the same way. And what would happen is, instead of investing into SPDR, and I'll tell you why. Now, the only difference here is that I have taken the last 30 years on SPDR, which is also an ETF that invests in S&P 500, but the management fee of SPDR is pretty high. So therefore, I will recommend doing it in VOO, where the management fee is much lower. So let's talk about this calculator. It's a very simple calculator. For instance, you are earning $5,000 household income after taxes, and if you invest 20%, that's $1,000. If you invest $1,000 every single month, and if you're getting a 3% hike every single year, you will be investing $570,000 over the next 30 years, and that $570,000 will translate into almost $3.8 million. That, guys, is a lot of money. If you're earning $5,000 and if you're getting a 3% raise every single year, and if you invest 20% for the next 30 years, reinvesting all the dividends that you're getting into one stock, it's as simple, it's one stock, you can actually make a ton of money by the end of 30 years. It's as simple as that, and it's based on real hard numbers from 1992 to 2022. Now, you can obviously play around with this number. You can say that, you are earning $10,000, you invest 20%, you can actually do, okay, I'll invest 10%, I get a 5% raise. So you can play whatever way you want to play with this. So you can download this calculator from the description below. I'll put in a link, and it's the same calculator that I use for budgeting as well. It's just a different tab. So just download if you have not done that already. Now, let's also talk about the elephant in the room, which is what happens if the market crashes. For example, we are seeing the market kind of crash right now. It's expected to crash in 2023. It did crash in 2008. It did crash in 2000 when the dot-com bubble happened. The market crashes are very usual. It happens usually in 8 to 10 years, and it's due for a crash right now as well. So what happens if the market crashes? There's a lot of anxiety in people when they see their stocks go down, but let me show again with hard numbers that it does not matter. So what I've done here is I've put the stock price every single year in the beginning of every single year, and you can see that every single year it grows by a little. Then it grew by a lot in 1996. It grew kept growing, till 2000, and then we had the dot-com bubble. And the stock price actually declined from $97 a share to $62 a share. So it was a continuous 3 years of decline. But the good thing there is that whenever there's a decline, the stock price reduces, and now you are able to invest into more number of shares because you're investing the same $500. That $500 actually buys you more shares. And that's what happened here. So you were investing 200 something shares, then the market price increased. Obviously the same $500 or same $6,000 for the entire year, $500 per month into 12, $6,000 for the entire year, bought you only 62 shares. But the moment market crashed, you were now able to buy more shares. In 2003, you were able to buy for the same price 96 shares. And again, the market started going up, and again in 2008 we had the subprime crisis, and again the market crashed by about 32%. And again you were able to buy more shares then. And then the market started going up. Then there was a mini crash in 2016. You were able to buy kind of the same shares, and it went on and on. Now I've also taken a projection of 2023. I don't know how we'll end 2023 or how we'll start 2023, whether there'll be a crash or not. And if there is a crash that happens, and even if we reach 2021 levels or 2020 levels, we again will be able to buy 3 more shares. So that's what happens when there is a crash. For the same amount of money, you can actually buy more. And when the market goes back up, those additional shares also add up to the growth and they compound together. So it does not matter. We have had 2 major crashes in the last 30 years. And even if we have 2 to 3 major crashes in the next 30 years, you will still be ahead on the investing game. But there are 3 caveats to this, 3 rules to this. Number 1 is we need to invest into growth and dividend ETFs. I would definitely do that. We need to invest in blue chip stocks. We should not be investing this money into something that's not proven, because that can actually go down to 0, and then your investments will actually not grow by 7 to 10% that you are expecting. Number 2 rule that I follow is we need to invest every single month consistently. And number 3 is we need to invest for long term. We should not be shorting shares. We should not be taking that money out. At least I don't do that. I would keep investing $500, $1,000, $2,000, whatever I want to for the next 30 years. And that would give me a massive return when I retire. Now, we need to also discuss when is it okay to save. There are 2 instances when saving is actually good. And number 1 is when you're saving for an emergency fund. That's 4 to 6 months of your expenses. That's very important because you can lose your job. You can have an emergency trip to India, and then you will not have to max out your credit cards. You can actually pull money out of your emergency fund. And this emergency fund, I actually keep in a bank account. It's fine if it's not giving me a lot of returns. I try to find the best possible place to keep it. Right now, I'm getting about 1.5 to 2% return in a GIC, but that's okay. I'll just keep putting more money a little by little every single year to keep with inflation. But it's very important to have an emergency fund, and it's okay to save for that and then start investing once this is filled up. And then if you are saving for a house, do not invest that money. And the reason for that is we don't know what's going to happen next year. If your investments actually go down, it's very difficult to pull those out in a loss and then invest into a house. So if you are saving for a house, do not put into TFSAs and ETFs and all these things, because then there's a very high chance that you will sell it at a loss when you're buying a house. Apart from these 2 reasons, there's absolutely no reason why you should save your money. And we prove that with time, with actual numbers, that there is a risk-free way of growing your money and not losing it to inflation. I'll end this with a quote from Warren Buffett. He says that the stock market is a device for transferring money from impatient to the patient. That basically means that people who short shares, people who sell out of fear, they are the ones who actually lose, and people who buy when people are fearful are the ones who win in the market. So it's a transfer of wealth from people who are impatient to patient. You need to patiently invest into this market for the next 30 years if you have to build wealth by the time you retire. That's all I have for today. I hope you liked this video. Do hit the like button and do subscribe to the channel if you have not done that. Do hit the bell icon as well, and do share this video with anyone who you feel would benefit from it. मिलते हैं अगली वीडियो में, तब तक के लिए बाय बाय।